Three great uses for infinite banking. Infinite banking is the engine that runs the tax-free cash growth warehouse finance strategy. How and what am I talking about? Infinite banking is a concept that uses the cash value of participating whole life insurance as a personal or family bank. The tax-free cash growth warehouse finance strategy is a finance strategy, and it encompasses cash flow strategy along with sweep strategy, snowball strategy, and chunking strategy using the infinite banking concept. In this short video, I'm going to present an overview of three of the most beneficial and powerful ways to put this fantastic strategy to use. First, I'll explain how to pay off high interest debt in a fraction of the time it would take without the tax-free cash growth warehouse and saving you a bunch of money. Then I'll explain how to pay your income tax while still earning high compounding interest on the money that you use to pay it. Then I'll explain how to pay off your mortgage in a fraction of the standard time and save thousands of dollars in the process. So watch to the end. This is powerful stuff. And at the end of this video, I will offer you a free bonus gift. Aloha, I'm Stan Cox, principal broker and strategist with SC Finance Strategies and Insurance Consultants. I'm also the author of the books on the tax-free cash growth warehouse strategy, and I'm the managing director of the Hawaii Financial Freethinkers Academy, a nonprofit financial literacy education organization. For the past several years, I've focused on and specialized in the infinite banking concept and developing the tax-free cash growth warehouse finance strategy. So if you find this to be helpful, please like this video and subscribe to this channel and share it with your family and friends. Also, please post your questions and comments here. Okay, so let's pay off high interest debt with infinite banking and the tax-free cash growth warehouse strategy. Pretty much every kind of bank loans are charging high interest these days. Most credit cards are charging between 15 and 29%, which in my mind is just legal robbery. So let's take a credit card balance, even at just the lower 15% interest rate, and see how this strategy works out. Let's say you have a credit card balance of $10,000 at 15% APR and revolving. If you pay the credit card company just the monthly interest charged plus 1%, you will be paying $225 a month, and it'll take 5.5 years to pay it off if you don't add any additional charges to it. And you will pay $4,688 in interest over that payoff period of 5 years, 5.5 years. Now, let's say you have a tax-free cash growth warehouse account. What I mean by that is a participating whole life insurance policy that is designed for maximum cash value growth and availability. And let's say you have $11,000 in the cash value of your account. Here's how you put the tax-free cash growth warehouse strategy into play. You take a policy loan of $10,000, pay off the balance of the credit card. Now you have a zero balance on your credit card, and you now have a policy loan with the balance of $10,000. Now, different insurance providers charge different interest rates, but the provider that I use the most has one of the lowest at just 5% simple interest. So already you will be saving at least 10% on the annual interest over what the credit card is charging. But there's much more to it than this. Remember, you were paying $225 a month on the credit card, so we'll keep that as your policy loan repayment. But now, with a much lower interest rate, and at that payment of $225, it'll take just 4 years and a couple of months to pay that loan off, and you will only pay $1,082 in interest, saving you $3,600 in interest. In addition to that, your cash value will be earning at the current rate for this producer 6.1% on the total of your cash value and compounding. So over the 4 years of payoff, your cash value will grow by $2,940. With the interest savings of $3,600, you're ahead by over $6,000 when paying off that high interest credit card the TFCGW way, or tax-free cash growth warehouse way. And now, making money on the money you pay for income tax. Okay, this is definitely one of my personal favorite strategies. You know that the IRS never pays you any interest. If you are self-employed and you pay monthly or quarterly estimated income tax, even though you're giving that money to the IRS before it's actually due, they don't pay you any interest on that money, not a penny. Same thing if you're a W-2 employee. That tax that they take out of your paycheck is going to the IRS well before any income tax becomes due, and the IRS doesn't pay you any interest on any of that money. That's always been irritating to me. Sorry for the facial expressions. But if you still owe any additional income tax after all that withholding or prepaying estimated tax all year, and you're late in paying the balance, what does the IRS do? They charge you interest on what's due every month until it's fully paid. Is that fair? No, it is not fair. In any case, here's how you can earn high compounding interest on the money you pay to the IRS for income tax. Instead of paying the estimated tax to the IRS, feed that money into your tax-free cash growth warehouse policy, cash value, each month or quarterly. Then when it's tax time, take a policy loan for the full amount of income tax due and pay that tax bill. Sure, you still have to pay the tax man, but in the meantime, all year long that you've been paying the estimated amount into your infinite banking account, it's been earning high compounding interest. Then, even after you pay the tax bill, all that money continues to earn the high compounding interest within your tax-free cash growth warehouse account. Now, you can't generally just deposit into the cash value of your account whenever you want. It has to be paid into one of the cash-rich riders that your policy will have been designed with. And you'll want to keep the total paid in below the MEC limit. So those considerations should be weighed when designing your policy in the beginning. Now, you may be wondering, if you're a W-2 employee, how can I do this? For you, since your employer is withholding the estimated tax from each paycheck, what you need to do is to get with your HR director and ask to amend your withholding directive. They'll have a form for that, same as the withholding form you no doubt completed when you hired onto the job. This time, however, you will put in the maximum exemptions allowable or claim exemption altogether from any income tax withholding. You'll still want to have them withhold the Social Security and TDI, just not the income tax. Then you'll notice that your take-home pay will be considerably higher than it was before. So then you'll put that estimated amount of income tax for the month into the cash value of your policy, the same as you would if you were self-employed and paying estimated tax. So let's say your estimated income tax is $1,000 a month. By adding that into your policy cash value instead of handing it over to the IRS each month, you have the potential to earn around $332 additional tax-free just on the money earmarked for the IRS alone. each year. But of course, it's way better than that because that money that you're paying in each month as your estimated tax is being added to whatever your cash value already is. And that total is compounding together. Now, let's talk about how to pay off a mortgage with the tax-free cash growth warehouse finance strategy. Mortgages are usually the biggest debt item we ever have. So it's going to take a good amount of money to pay it off. The thing with mortgages is that they're amortized. So the loan principal remains close to the same for the first 10 years. And the majority of your payments are just going to pay on the interest, which is calculated in advance and added on to the front end of the mortgage. So what we want to do is hit that principal as much as we can. So whatever the principal is on the mortgage, the strategy is to take as much of a policy loan as we can and apply that to the principal only. Then, as your cash value grows and you can take another policy loan, you take another policy loan and pay off another chunk of the mortgage principal. By doing this, the amount of interest will be adjusted based on the principal balance. And you will save thousands on the interest charges over the full duration of the payoff and get the mortgage paid off in less time, generally around 30% less time, depending on how much you can chunk it down each time you take a loan. And when you pay against the principal each time you chunk it down. In the meantime, I'm not going to go into, or in the interest of time, I should say, I'm not going to go into a lot of detail here. But as I said, you watch this whole video, I'll give you a free bonus. And here it is. My email is listed in the description box below this video. Send me an email. All you need to do is put bonus in the subject line, and I will send you my book, Tax-Free Cash Growth Warehouse, Nuts and Bolts. This book details the 3 strategies I've just been talking about and an additional 6 ways to use infinite banking in the tax-free cash growth warehouse strategy. Of course, you can say whatever you want your email to me, but you don't have to type anything in order to get the free book. Just bonus in the subject line. You have questions? We have answers. For a more complete explanation of the tax-free cash growth warehouse strategy, you can watch our free 60-minute webinar. The link is in the description box below this video. The link to buy my books on Amazon.com is also below. If you'd like to book a free phone consultation with me, the link is to my Calendly page is also below. And if you'd like to apply to become a client of ours, the link to the application is also below. We're here to help. We look forward to helping you. Aloha and mahalo for watching.